Most people fail at investing, and it's not because they've chosen the wrong company. It's because they never set up an investing system that they could stick to. So if you want to set up a dividend portfolio in 2026, it's important that you set up a plan that you'll actually follow. So think of this as designing your investing lifestyle. The first step is deciding the structure of your portfolio. Are you going to invest in ETFs, in single stocks, or a combination of both? The best option here for you is the one that you're going to invest in consistently, the one that makes sense for your investing style. It really needs to be simple and repeatable. That is the key to building a strong portfolio, is consistency. So if you can set up an investing schedule and system for yourself, it's going to be far better for you than just trying to pick the next hot tip. We want to build portfolios here. So you want to set up a schedule and a calendar system that helps with your investing. First, work out how much you can invest. This can either be a fixed amount or it can be a set timeline. The key here is consistency, whether it's the amount that you're investing each time or the time frame that you're investing. So with timeframes, I think monthly is great if you can do it, but quarterly is fine as well. It doesn't really matter. All of us have a different amount to invest as long as you're investing at a regular time frame. You can take advantage of your trading fees here. Say your trading fees are a set amount up to $5,000. Maybe you want to set your investing to around $5,000 to maximize that trading fee. So instead of investing $1,000 at $5 a trade, you're investing $5,000 at $5 a trade. You don't have to do it this way, but just maximizing your profit that way can be a good thing. Your schedule also needs to take into account how much you can save each time. So it is important to have a look at your budget and to see how much you're allocating to investing. And even if you can tighten up your budget somewhere and use some of that money to invest. Once you've decided on a schedule, it's now time to add those buy days to your calendar. We are not leaving this up to chance. We are making sure that it's in our calendar and we're going to do it every single time. You don't just want to wake up and go, I feel like investing today. You have set days that you're going to buy stocks now. This uses a dollar cost averaging method, so it doesn't really matter what the price is doing on that day. If the price is down, you get to buy more of that company, and if the price is up, you buy less, so it averages out. You want to have these days in your calendar because you don't want to just decide that you're going to invest. It's in the calendar. That's your investing day. So along with your buy-in days that you've scheduled, now you're also going to set up a check-in days where you'll actually go and check your portfolio to make sure everything is great. You do not have to do this very often at all. You can do this at the same time as your buy days if you want to, but I recommend keeping them separate, mostly because you only want 1 or 2 check-in days a year. Yes, you do not want to be checking your portfolio every single day. It's going to be too hectic. This is going to prevent you from making any emotional decisions if the market is down or up. A calm investor is a profitable investor. What you're going to do on these check-in days, you're just going to go through your portfolio, what you currently hold, make sure that everything is still fine. Are they still paying good dividends? Are the dividends still consistent? Is the growth of the company still in line with something that you're happy with? Now, obviously, price growth is going to be impacted a lot by whatever's happening in the market overall. It could be that the stock is down and there's nothing wrong with that company at all, but it's still good to go in and check every 6 months or 12 months. During this check-in, this is a good time to rebalance if you want to rebalance your portfolio. Rebalancing just means you look at your overall holdings and see if there's one company that you have more money in than all of the others. Now, I don't necessarily think you need to have an even amount in every single company or fund. You want to prioritize those companies that are making you the most money, either through dividends or growth. But sometimes, especially if you have a dividend reinvestment plan, say, sometimes one company can tend to overpower your portfolio. So you might want to think about rebalancing if that's the case. These check-in days are also to make sure that you are happy with the investing style that you've chosen. You can change your investing style. I don't recommend changing it too often, but perhaps you started as, say, a growth investor or a value investor, and now you want to move into dividends. These check-in days are also good to try and rebalance and have a look at how your strategy is going and whether you're still happy with it. The idea here is you don't want to be reacting to headlines and sensationalism. You want to just make sure things are calm and still on track with what you want for your portfolio. So what can you expect over time when you start investing? Now, the first 12 months of investing is going to be so slow and quite volatile. This is where most people quit because they'll put some money into a company and it might fall as soon as they invest. That always seems to happen, right? And so they give up and sell really quickly. They panic sell. So it's really important to stay calm and not panic sell within the first 12 months. Unless you've invested at a really good time or you've had some luck in the market, your portfolio is probably not going to do much. It's going to be just the money that you've put into it. You might have had a few dividends by now, but they're not going to be significant. Now, medium term, 1 to 5 years, say, this is where you're going to start to see some of the progress of your investing. If you've been investing consistently, your portfolio will be growing. It is still early days, of course, but your confidence as an investor is starting to grow and you're going to be more sure of the decisions that you're making. Dividends will be growing and hopefully you've also seen some price growth by now. Now, longer term, more than 5 years, you're going to start to hit your stride now. This is where compounding starts to really show. You don't see compounding in the beginning because it's too small, but over time with price growth, with dividends growing, your income starts to increase. So now your income is becoming more meaningful. You're starting to become a much more confident investor because your strategy is now working for you. So yes, calm investing is a long-term strategy. You might not see a lot of progress for the first 5 years. You will still, of course, be getting dividends during that time, but over the long term is when things start to snowball and things get a little bit more exciting. Now, you might think, 5 years, I can't wait that long, but that time is going to pass anyway. So why not? So I briefly mentioned dividend reinvesting plans. Should you reinvest the dividends? There are pros and cons to DRPs, dividend reinvestment plans. The pros are that you won't be paying any trading fees. Instead of dividends, they give you more shares so that next time, because you're holding more, you get more dividends and so on. That compounding effect can start to work a lot quicker. Also, it's just easy and automatic. You don't have to think about it. It's a no stress way to build your portfolio. The cons, however, to a dividend reinvesting plan is that sometimes you just don't want to reinvest in that particular company. It is possible that you can overweight one particular company as it increases because that compounding effect, which is great, can also make that one of your biggest holdings over time. Another thing that not every company or every fund has a dividend reinvesting program. So I do like dividend reinvesting programs for the ease, but there is something to be said for taking the dividend and then choosing where you want to put that investing cash next. Work out which one fits with your long-term wealth investing goal. So let's quickly talk about diversification. My next video is actually going to be specifically on diversification, so we won't go into too much detail here. But generally, what you want in your portfolio is to have a good mix of companies and a good mix of sectors. So if you're going for single stocks, having between 8 to 15 companies is a great amount. If you're using ETFs, you really only need one, but you might have a second one or maybe even a third one, but you wouldn't want more than that. And of course, going for different sectors is great because some companies thrive in different market conditions. For example, during the pandemic, retail companies actually did really well, and so did transport companies because nobody could leave their homes, so everyone was buying online. So with different market conditions, different companies and different sectors can do better than others depending on where we are. So that's why it's good to have a mix of different sectors as well as different companies. The system that you set up, the one that you stick to, the one that makes consistent investing over the long term, one that has diversification, one that fits your investing style, that's the one when the market gets a little volatile and crazy and noisy, you get to stay calm and stick to your goals and of course, stay consistent. I hope you enjoyed this video. I'll see you in the next one.